Good afternoon. Thank you all for joining us today for the Lytham Partners Spring 2024 Investor Conference. My name is Joe Dorame, Managing Partner of Lytham Partners. I would like to welcome Flow Beverage Corp, a premium and sustainable water company. The ticker symbols are Flow, FLOW on the Toronto and FLWBF on the OTCQX. Presenting from the company today is Trent McDonald, Chief Financial Officer. As a reminder, management will be available for one-on-one virtual meetings. If you'd like to sign up, please visit lythampartners.com/spring 2024 and click the investor and attendee registration button. Now I'd like to turn the presentation over to Trent McDonald, Chief Financial Officer at Flow Beverage. Trent?
Hi, Joe. Look, thanks for having us. We enjoyed these conferences, so glad to be part of them anytime you tend to have them. Today, I'm going to give just an overview of the company and where we are, where we're headed, and hopefully give some insight into where we think we could be going forward, which is a much healthier place than where we started. Just stop here for a second on our investor disclaimer, and then we'll move on. So first, for anybody unfamiliar with Flow, our story is such that we were founded by Nicholas Richenbach off the back of his own family's water source in a small community called Mildmay in sort of north central Ontario. It was founded in 2014 off the vision of taking what was one of the best waters and still is one of the best waters in the world and putting it into the most sustainable packaging available to bring to the masses to fight, other things, other types of forms of packaging, of course, led by plastic. And so our water is natural alkaline, having an 8.1 pH level. It is filled with wonderful minerals. It's actually classified as a mineral alkaline spring water. It has won several awards for its taste, and I can tell you that we have a very, very enthusiastic growing fan base associated with our water. And it's really abundantly supplied in this natural spring of ours. And so the portfolio is that we wanted to take a portfolio approach rather than just having our original water. We decided to put organic flavors inside of the waters, and we've won several awards. In fact, Cucumber Mint has won best flavored water in the world at least 2 years. And that being the case, it's really just about having a small amount of profile flavor within it, so it's not overpowering. And of course, it has no artificial or sweet or other types of sweeteners. It's just a very, very, very good water. We also have put a lot of time and effort and work over the last several years, especially into identifying who is our target consumer. And we've done a great job of that, with help from a lot of external consulting. And, our consumer is basically, although lots of folks drink our water, it's not just one, generic, group of individuals, but essentially the way we market our water is towards 25 to 45-year-old, mindful, balanced individuals who balance their work and social life and exercise and is very health conscious. We have a very good promoter score, because again, we have these very loyal consumers, and that base of consumers is growing all the time. So our promoter score is actually 79, which is very, very high. The evolution is, if you look back at our launch and, we're able to get into Whole Foods, who are sort of, are very, very behind companies like ours who are natural, organic, types of organizations. And so then we went into Sobeys and Longos. And from there, we just managed to expand. And we use a lot of food service. So we were able to get into Starbucks. You see that at the end there in Canada. And we're in almost all Starbucks across Canada, doing very well. They have their own sustainability goals. And there was a groundswell of consumer feedback that they wanted to have more sustainable options when being at Starbucks, and Starbucks and us were able to work that out. And it's been very, very good for us. Off the back of that, our e-com channel went up, over 60% within just a couple of months. And that's what good food service does for CPG companies such as ourselves, where you get a lot of conversion into higher margin channels off of the food service clients that you have. And we'll talk a little bit more about that and that strategy going forward. Some of the bigger milestones, and we just finished our Q1, or sorry, we didn't finish it. We announced it back in mid-March. We just actually finished our Q2 as of April 30th, and we'll be announcing that mid-June. But in Q1 2024, just to remind anybody who doesn't know, we've gone through a rebranding, and you see some photos of the new rebranded product here. Which pops out as being more, a beverage, a water beverage, which maybe some uneducated consumers may not realize it's actually water inside of our box, because, it's a format, especially in the US, that people aren't accustomed to having water out of. They're accustomed to plastic, aluminum and glass, but Tetra is a new format. So you're not just selling consumers on the wonderful product, but you're also selling them, and to a large degree, on the format. And so we believe this is going to do a lot more to position us not only for consumers to know that it's water, but also premium water, because it has a bit more of a premium look to it. And we are a premium water. So we put ourselves in that category, and that's how we measure ourselves. So we believe there's a lot of good things here. We've also optimized our product portfolio. We're down to 4. We've gotten out of vitamin. We've said, look, as part of our long-term restructuring that we've been doing since I've arrived at the organization, that was just about a month or 2 after Nicholas came back in as CEO. And so the 2 of us have been on this path among, the rest of our team. Obviously, it's a full company, and we're going to talk about this, but, we've done a lot of this restructuring, and some of it is just the optimization of the brand itself and how we position ourselves, and what we're going to focus on, which is profitable channels and working with a tight family of SKUs. And so therefore we've gotten out of vitamin, among other things. So we also, as anybody might know, we were looking at one point to divest of our second facility. We'd already divested of the Verona, Virginia facility about 1.5 years ago, but we're looking to divest out of our Aurora facility. But with all the work we had done to sign up great co-packing clients on wonderful manufacturing services agreement with take or pay features, we decided to hold on to that, because we've now expanded from 3 to 4 lines. We'll talk about that in a second, and we plan on expanding even further. So we announced, as anybody would know, several co-pack contracts led by Beatbox, who themselves, if you don't know who Beatbox is, again in a Tetra Pak format. They're doing absolutely wonderful, great company, sort of party punches, having approximately 11% alcohol. And they're doing really good in the United States and growing leaps and bounds. We signed a 5-year contract with them that represents $115 million of revenue to us over the term. We also added BioSteel, and when they came out of their insolvency, and now they are under new ownership, and what a great ownership they have now, and they're doing really well. And now we have that. And so that's another 3-year agreement. And then we have, Joyburst. So altogether, close to $150 million worth of contracts. And we recently completed a private placement to help bridge, because obviously not divesting, which was a recapitalization plan, there's going to be a lot of bridging of cash flow to get to cash flow positive, which we've publicly stated we believe will happen in our 4th quarter. So looking at strategic growth priorities, our goal is to maintain Flow brand growth in retail in both Canada and US, and get more strategic food service partnerships. So, we've gotten out of some as part of our restructuring, and, are looking at ones that are a little more accretive to growth, where you have a better opportunity to convert those customers who are, have trialed the product in food service to put them into higher margin channels. And we have new channels of distribution as well that we're still continuing to expand upon. We've put in a 4th line at our Aurora production facility, went from 3 to 4, and that's been working out really well. And we have the lines all sold in terms of the capacity. And now we're actually looking at a 5th and 6th line, which we can talk about down the path. But we're looking at constantly increased capacity as not only we grow, but our co-pack clients grow. And then financial improvements. You know, we have the co-pack revenue, obviously the continued benefits from our optimization and restructuring, which we'll talk about. You know, we're slowly getting to stabilize working capital. Again, it's tight as we move through this period of holding on to the Aurora facility to get to, you know, to the point where actually cash flow positive, which still is a few months away. But we do have that clear road to profitability, which we've never had before. Certainly not when I came here, and now we do, which we're very, very proud of. So we also are most proud of this, you know, our positive impact on the planet and people, which again drives a lot of very, very loyal consumers. And sustainability as a business, as an industry, is not going anywhere. It's actually just growing and growing and growing. And so we do a lot of ESG reporting, and we're B Corp certified. And our B Corp certified, our ESG score under B Corp is 126.5, which is the highest in the water industry in the world, and puts us in the top 5% of all B Corp certified companies on the planet. So we do a lot of things beyond just having wonderful organic flavors and great packaging to be able to get those kinds of scores. But we also like things like community engagement with some of our partners like Starbucks, and we do a lot of things with Live Nation and with Tetra itself. We go way beyond the plastic bottle, like we say here. We use a lot, you know, up to 75% of renewable materials. You know, we're carbon neutral as an organization. We're part of the Amazon Climate Pledge member. And you know, we do a lot of things that people don't understand that we do. You know, we're promoting recycling through the Carbon Council of Canada. So there's a lot of things that we do as a company that we take ESG very seriously, and that's not going to stop anytime soon. Some of the financial highlights from Q1, we had 6.6 million in Q1, which was a decrease from Q1 of 2023. And, you know, look, even our consolidated revenue was 8.3, which is, again, a pretty big decrease from last year. And our gross margin was negative. And, you know, while also having, you know, a very high adjusted EBITDA that was negative. So I'm not going to go into all of these things, but we were on a path when I came back to what I think most people felt was insolvency, to try to get us on a path to profitability. And in doing so, we had a couple of quarters of planning and what needed to take place. And that was after we recapitalized with some debt and divesting of the the Verona, Virginia production facility. But now, over the last 3 quarters, ending Q1, that you're looking at the results here, we did all the restructuring. Like you plan, you recapitalize, but then you actually get into execution mode. And we've been restructuring like crazy, which is expensive. It's complex, it's expensive. But as I said, after, you know, at the time we were, you know, releasing these and we had our webcast, I said to everybody, look, this is the last time you're going to see a quarter like this out of flow. Our goal from here on out is to start showing a much more stable balance sheet, a much, much healthier P&L, and to show that path to profitability. And you know, we're through Q2, and we've said to everybody, I'm not giving any guidance other than to say what I've said before. Q2 is going to be a really good quarter comparative to what people have seen in the last several quarters. And then we do believe from there, you're going to go into Q2, 3 and Q4 and get to even better quarters, so much so that we believe we'll actually be EBITDA positive and cash flow positive in Q4. And Q4 starts, you know, August 1st, which is just a very short time from now. So, and we have a very clear path to that. We can see, we have a lot of visibility that we didn't used to have, because one of our parts of restructuring was completely dismantling and reinserting a IT ecosystem that gives us much better information on a much more timely basis, much more accurate, so we can make better decisions and have visibility to what's happening around us. So again, just more financial results from Q1. You know, sales and marketing, G&A, salaries and benefits, all down from last year in totality. And you know, G&A was up, but there was a lot of things in there. Again, it was the last sort of true quarter of restructuring, and we still had to take a lot of one-times in there. Margin clearly negative. That was there was a lot of write-off of raw materials associated with getting out of vitamin, among many other things. We do not remotely expect that is indicative of our gross margins going forward. And we believe G&A still has room to improve from here. And so I think, the EBITDA loss and the adjusted EBITDA loss, again, we've never had great EBITDA here since going public in June 2021. But I think you're going to see dramatic improvements starting with Q2, which we again released in just a few weeks. But in order to have gotten to that point where we know what our path looks like, we had to do a massive restructuring. So all functional areas were transformed completely. We're sitting here with less than 50% of the workforce we had just 1 year ago in functional area departments. We went down the path on logistics of 3PL and optimization of warehousing, e-com, last mile, so on and so forth. And we know we've taken at least $6 million out of that particular area while we've been growing volume. So it's actually, quite an improvement. Production optimization has been a very big key for us, trying to drive down the standard overhead associated with running the plant. And we've done a great job there. And we've also, and volume picks up, obviously that carries more overhead, but just in general, we've controlled costs while improving capacity utilization, which really does drive down cost of goods. And that leads into our new operating model where, we're no longer having our own products produced out of Verona, which we used to before we sold. After we sold that to BioSteel at the time, now everything's produced out of Aurora, so we're not paying those co-pack fees where we actually get the benefit of the underlying cost of production for US-based product, which obviously is driving a good cost of goods and a better margin. So there's a lot of things that we've been doing to improve process, and in totality, we think from a run rate we've shaved $20 to $24 million out of costs. So that's not a small nugget. And again, we believe that we're going to be in Q4 operational cash flow positive and EBITDA positive. So this is something we always sort of talk about, fairly so. And we always say this. Somebody asked me recently, do you think you're fairly valued? And I said, absolutely. I think we're fairly valued. I think we're fairly valued because people don't understand or know what it is that we've been doing. And so looking at what's been public. And from what's been public, we're fairly valued. I think investors look at our company as a company that's going to fail. And when that's how you're being valued, then you can't really look at the comparatives, because if you start looking at the comparatives, as we show here, we're not remotely valued like our industry. Now, that said, I think Q2, which is complete and we'll announce, is going to look a heck of a lot better, and it's going to show people like, holy, there is actually something that's happened here, and then there's a path. And so I think you start looking at Q2 and then Q3 and Q4 as we go forward. If our price was to remain where we are today, then no, we would no longer be fairly valued. But I think at some point the market gets it right, and you start to get repriced. So I think we just have to continue to focus on the results and doing exactly what we said we would do. And I think we're on a great path to do just that, and value hopefully will follow.
Great. Well, Trent, thank you very much for that overview. Since we've got a little bit of time left over here, let's expand a bit on a few topics. During your presentation, you talked about this operational transformation. Can you help us understand, what kind of time frame we're looking at for you to complete this transformation?
Yeah, you know what? It's broadly complete now. There's some things that we're still doing in relation to logistics and operations, and there's some tweaking we're doing on, functional areas as well. But I would say 85% of what we had set forth to do has been completed. And this is what we're so excited to start showing investors, starting with Q2, is, what that starts to look like. And obviously one of the biggest parts that we still have to implement and get going is the alcohol production with BeatBox. We're way down that path. Our fourth line is now up and running and operational. We're not doing alcohol yet, but we believe that will be ready to go within several weeks from now. And we'll actually be producing products for BeatBox. And so there's a lot of upside that's going to come from that in terms of capacity utilization and even more co-packing, which is going to drive down the cost of the Flow brand as well as you know, the co-packing takes on more overhead absorption. So there's that to still do, but we've done a lot, and it's been a lot of heavy lifting. It's been very expensive. I always use the analogy. It's so much easier when you're building a house and you just dig a hole and put in a great foundation than it is to have to put a brand new foundation under a house that already exists on a faulty foundation. You know, much more complex, much more expensive, takes a lot more time, and that's what we had to do here. But we're broadly through it.
No, that's great. Now, if you achieve your financial targets in fiscal 2024, what could fiscal 2025 look like?
Great question. You know, fiscal 2025, I think is going to be a year that will surprise a lot of people. You know, there's a lot going on with Flow branded products from a sales perspective, starting there, where it almost looks like we're flat to down, and you know, so down for the first couple of quarters, and you know, by the end of the year, our goal is to be up to slightly up on Flow branded product, but essentially, you know, it's not really all that it seems to be. In essence, we've actually pulled out a lot of different things that we used to be in, dollar channel, some of our major like Norwegian Cruise Lines, which is a big contract for us, but we're losing money on those kinds of things, and those are big for us. So you're actually declining between that and some other things, vitamin, you're declining by 25-30% on what was last year's sales. And so to be flat or up slightly by the end of the year, that actually represents significant growth. But moreover in profitable channels. So you start with that, and then you get a full year of 4 lines producing on co-pack, you know, and next year starts to look really good on a top line basis. And there's other things we're doing within Flow to grow next year. So I think next year starts to look really good. Top line cost of goods is, you know, going to be much better. And we have our G&A under control. So I think next year there's reason for us to believe that, you know, pretty much every quarter will be EBITDA positive. And I think, you know, we should have a fairly robust P&L next year.
That's very helpful. You know, with your relationships with key companies like Starbucks, Costco, Live Nation in Canada, what's the possibility of getting those channels established in the United States?
Yeah, I can't speak to the probability, but I can say that it's been one of our primary focuses. You know, we constantly are in communication with Costco, which is, you know, they run themselves a little differently in the U.S. than they do here in Canada, but we have very strong customer base in California, you know, New York soon, and there's some things that are happening in New York, but we're expect to really unlock that market here coming up in the next couple of months, and then Florida. So you look at those areas, and I think we'd be a great fit, especially in certain SKUs we're developing for Costco. And here in Canada, you know, we're rolling out some things with Costco that we think are going to be really good, and again could be very good in the U.S. if they were to choose to go in that direction with us as well. Live Nation, that'll be a little more difficult because of some contracts they have with other of our competitors in the United States. It's not as open. But look, we're working to unlock a lot of things in the US right now, and we've changed our direction in terms of the strategy around sales and brokerage and some of the consultants we've brought on. So I think there's reason to believe that next year looks a lot better than this year in the United States.
Oh, that's great. You know, you guys have built a pretty good, let's say, business within the natural food aisles. You know, how do you get into the traditional grocery aisles?
Yeah, not easy. I can tell you that. You know, one of the problems we have is it's a double-edged sword here in Canada, especially, where we've been such an important part to the core offering and planogram within certain major retailers, grocery retailers, in their natural food sections, that, you know, it becomes an internal battle on their part between allowing us to go into conventional or staying with natural food. which has been a challenge for us because clearly we want to have a presence in the conventional aisle. And so I think, where we have had that tested, we've done very, very well, and we have a very big case to show that we need to be in conventional, not only for ourselves, but for the benefit of the retailer, because there are always, as always, there's always underperforming SKUs within any area of a grocery retailer that, if you put somebody like us in there, in this case in water, they derive a benefit, and we derive a benefit. And we always say, look, we're a Canadian-based, sustainable, high graded ESG company. And so I think it's incumbent upon our partners to really recognize this about who we are, where we come from, especially here in Canada, and put that effort behind us to help make us successful. I think it's unfair if the results are there, which they are, to inhibit that. And so we really want to start doing that in the United States. Obviously, Whole Foods, Sprouts, and some others have been very, very successful for us and continue to be great partners. But we also are looking at conventional aisles down there too, in a lot of larger retailers like Publix, where we're in today. So I think we just need to keep pounding on that. I think we have good case studies to show that we're successful whenever that happens. And if we do that and get in, obviously there's a huge unlock there.
Very good. Turning to your co-packing business, how large can co-packing operation become?
Large. Yeah, it can become very, very large for us. Like I said, we have a fourth line we just put in. We're working with our partners on expanding from there to do a fifth and sixth line, and even from there, seventh and eighth. We have a great production facility that can expand, and we have an option on another tertiary site that's very, like, half a mile from our current site that could put in 4 lines. So there's reason to believe we could get to at least 14 lines in Aurora from where we are right now. And our partners are all very aggressively trying to grow, whether it's BioSeal, Beatbox, Joyburst, and then we're doing a few things still with some other big partners. It's no surprise, and I don't think we've hid that we do some work with Vita Coco. So depending on what happens with all these co-pack clients, I think there's reason to believe that we could grow substantially from here, very materially.
Oh, that's great to hear. Let's say, from an upcoming capital requirement, does Flow have anything that you need to go raise some additional funds for?
No, not specifically. We have a very good lending partner, and we don't, let's be honest. I mean, I know there's always this overhang on stock when people think that somebody has to go out and do a public offering. And I can't sit here and say that we're never going to do a public offering. But I can say we're not going to do it, unless we, I don't know under what circumstance, because you never say the word never, certainly not in the executive in a public setting. But it is not our intent or our goal to do a public offering at a low valuation because it's too dilutive. And so we're staying away from that. And we'll look and see what happens down the path. But we've never hid the fact that we'd like to get onto the NASDAQ, and which we believe will unlock shareholder value. And, we believe we have a lot of the qualitative things that go with, exchange traded funds, mutuals, everything else that are ESG sustainable focused funds where there's, multi-billions, maybe even $1 trillion worldwide that's invested in those kinds of funds, and we're not a holding of any of them. So if we, but for the quantitative issues that we have, whether it be low market cap, only on the TSX, thinly traded. But as those things start to change, we open up that whole world for us, and I think that becomes a value unlock as well. Certainly, we think of it that way. So. At some point, maybe we do something strategic because, it makes sense, maybe to deleverage, and, that's good for everybody. But we'll see. It's certainly, not while we're sitting at a value like we are now.
Very good. Last question. Looking forward, what are the key milestones that investors should be looking for in fiscal 2024?
I think the key milestones as we go forward is really to, take a good hard look at where the G&A is going, where our cost of goods are, where our gross margins are, and see whether or not we're doing what we say we're going to do. And I think coming off of Q2, I think that's going to be the very first step. Like I said, we're
Mhm.
largely done of our restructuring. So I think for most folks, it comes down to that. Are we getting the results we say we're going to get? And are we going to get all the way to cash flow positive and EBITDA positive? And I think again, there's reason to believe that we will. And so, but we have to gain that trust in our investment community as well.
Very good. Trent, thank you very much for your time today. We greatly appreciate it.
Oh, thank you, Joe. I really appreciate the opportunity.
All right. Again, if you'd like to sign up for a one-on-one meeting, please visit lythampartners.com/spring 2024 and click the investor and attendee registration button. We wish you all a good day and enjoy the conference.